All right, it's showtime. Hi, folks. As you know, our topic today is understanding advanced retirement planning. And we're super jacked to be addressing this topic with you because we believe that more people should at least know and understand better what some of the most important things to plan for in retirement are, and why most financial planners lean on certain solutions to address them. To me, this is extremely important because it's been my suspicion for quite a while that sometimes when we've recommended certain strategies and products and solutions to either mitigate taxes or protect from potential financial losses, it sometimes feels a little like some of our clients and prospective clients don't clearly understand why we're making these recommendations, and thus may think that we're just trying to peddle financial products or that we're being overly zealous and trying to somehow make more money. So the truth is, or should be, that whenever we make recommendations, there should be a demonstrable before and after outcome that clearly shows at least a potential better result for the client if and when the strategy is actually implemented. So it's our goal today to first break down some of the basic events that all retirement plans are made up of. Then secondly, to discuss some of the possible pitfalls that can either A, cause less than optimal outcomes for your plan, or B, completely blow them out of the water or at least maybe derail them a good bit. And then to show you the impact that certain financial strategies and products can sometimes have to assist in avoiding these types of adverse situations. We're going to look at the before and after effects of things like changing the account harvesting choices, which is a fancy way of just saying what happens when you change the order in which you spend money from each of your different accounts. We're going to look at Roth conversions, the impact of a cut in Social Security income, because at this time, it's definitely going to happen sometime between 2033 and 2035 if Congress doesn't do something before then to stop it. We're also going to look at the effects of the early death of a spouse, and finally, the incurrence of a long-term care event or events, because it could be a reality that both spouses in some cases could find themselves in need of long-term care services. Now, our approach for this today will be very much in black and white, meaning that we're just going to look at how much a person's assets or estate would be worth at the time of their death if and when these recommended strategies were actually implemented or not. Also, we're not going to be too complicated with this. We're only going to be comparing one type of a solution, mainly the ones that we prefer at our firm, to the alternative of not implementing it. So, of course, we know that there are always 9 ways to skin a cat when it comes to choosing different strategies and solutions to improve things. Meaning that there are other products or approaches that could yield similar or maybe even better results than we're showing you, but that we just may not really be privy to at the moment. This has certainly happened before and probably is going to happen again. So that being said, the reason for our comparisons today is not for us to promote our favorite strategies and solutions. It's purely for conceptual purposes alone, so that you can experience the thought processes that we go through when making such recommendations. Okay, now that you guys have a clear understanding of what we're going to cover today, before we jump into it, I'd like to thank each of you for joining us today to discuss this extremely important topic. My name is Brian Dougherty of PLC Financial Solutions. I'm your host, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Buddy, I'm here. You stopped my video. My video is not on, just so you know.
Uh-oh, hold on a second, folks.
Not that you need me, but I just want.
Everybody wants to see your pretty face. You kidding me? Did you open it? There she goes. All right, say hi. Rachel's gonna be, as always, our moderator for it. So she'll be handling all the comments and questions as we go along. But before we get started, let's take care of some general housekeeping first. If the screen is not big enough for you, you can click on the View Options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One called Chat, it's for your comments, and the other called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, oh, excuse me a second. Let me get a little sip of water here. All right, that's better. Next, I'm sure that many of you guys were going to have questions about the material as we go along. However, since we have a good bit to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in the boxes below, because at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will actually be posting a link for you to schedule that at the end if you so choose to. Next thing, this webinar will be recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You're going to have plenty of time to check it out at your convenience. Also, because we want to make sure that you're all paying attention as usual and that you have some fun as well. Before we answer any questions, we have a 6-question quiz for you at the end as usual. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of their choice. So make sure you have a notebook handy to jot down some brief notes related to some of the bullet points that I'm going to point out to you as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. Whew. So now that we got that over with, I have one for you, and it's a new one. What kind of exercise do lazy people do? Diddly squats. That was a good one, right, Rach? Come on, give me a little clap. All right, I'll keep the day job. All right, so let's get started. So to start with the basics, let's first discuss some of the different retirement vehicles that are available to us to use as part of our retirement plans. Fortunately, there are a number of different strategies and tools to choose from when planning for retirement. For the purpose of this workshop, we're going to focus on the most common ones as it relates to both investments and insurance as we move forward, such as tax deferral on retirement savings, tax-free retirement income, employer contributions, life insurance, and long-term care insurance. So to start, we're going to start by discussing some of the different types of savings accounts that our government has made available to us when saving specifically for retirement. The first are tax-deferred savings accounts, which are registered with the government and provide deferral of tax obligations. This means taxes won't be due on this money until you withdraw it from your account. These are great if you think you're going to be in a lower tax bracket during retirement. If so, by saving in this type of traditional retirement account, you'll definitely be able to reduce your taxes, your lifetime tax bill for sure. The most common tax deferred savings account that we see today are the traditional IRA and 401k. We'll talk briefly about the differences between them in just a moment, but let's first talk about some of the similar rules related to them. For a 401k in 2022, a person under age 50 can contribute up to $20,500. And at their age 50 and over, the limit is $27,000, which is an extra $6,500 for what is called the catch-up amount. Also, you must be able to legally work in order to contribute to a 401k, which means that in the US, since you can't legally work until age 14, then 14 is when you can start contributing to one. However, employers aren't required to offer an employee a 401k until they reach at least age 21. Now, for an IRA, the contribution limit for someone age 50 and under is $6,000, so it's a good bit less, and $7,000 if you're age 50 or over. Furthermore, there are no age limits to open an IRA, except when it comes to a simplified employer pension, or what's known as an SEP IRA. Then you need to be at least age 21. However, there are two main disclaimers when it comes to qualifying to opening any type of IRA. The first is that you must be working in order to contribute to one. And the second is that you can't contribute more than what you make. So if a teenager has a part-time gig making $5K a year, then they can put $5K into their IRA. However, their parents couldn't spot them another $1,000 in order for them to get up to the $6,000 limit, which applies to people under age 50. So with that all being said, the overall benefits of pursuing the tax-deferred route include tax-free growth in your savings and usually, but not always, less taxable income at the time of withdrawal. Okay. IRAs and 401ks are the most common investment vehicles for planning and saving for retirement. However, there are others that work very much the same, but are utilized with certain types of situations and companies. IRA alternatives are, I just mentioned the one, SEP IRA, and what's also known as a simple IRA. And they're alternatives for a traditional IRA, and they are for individuals who either own their own small business, example of a sole proprietor or a small partnership or even an LLC, or for some type of freelance worker where they can earn money outside of an employment situation, kind of like an Uber driver or something like that. Now, they've been created so that individuals who are in business for themselves in some capacity can easily create retirement accounts for themselves and even some employees without the hassle of dealing with more government regulations or having to hire a third-party administrator, otherwise known as a TPA, to oversee the plan for them. Also, these types of IRA accounts can still be funded with pre-tax money and allow individuals to enjoy all of the same benefits as traditional IRAs, but they do have higher contribution limits. For instance, the SEP IRA in 2022 allows the lower of $61,000 or 25% of your adjustable gross income. So for example, if someone makes $100,000, then they would only be able to put in $25,000. They'd have to make 4 times $61,000, which is like $244,000 in order to be able to max it out at the $61,000. However, they also are required that the small business owner contribute the same for each employee as they do for themselves. And catch-up contributions are not permitted in SEP IRAs. Now, when it comes to simple IRAs, the 2022 contribution limits are $14,000 for those under age 50 and $17,000 for those 50 and over. Now, 401k alternatives are also known as 403bs and 457b plans. They are both tax-deferred employer-sponsored retirement plans, just like a 401k, but they're utilized with only certain types of businesses. They're typically offered to employees of private nonprofits and government workers, including public school employees, firefighters, police officers, etc. And they function very much the same as a 401k plan as well, because they too are defined contribution plans that allow participants to shelter money on a tax-deferred basis for retirement. The one major difference between the two is that 403b plans are considered qualified plans because, just like 401k plans, they are governed by the Department of Labor under the ERISA rules. And on the other hand, the 457b plans are considered non-qualified plans because they are overseen by the IRS, just like an IRA is. So what is also great about many of these types of plans is they allow for employers to offer voluntarily a certain percentage of an employee's gross salary as an employer contribution to the account. And in many cases, it's done on a matching basis, where the employer will match whatever amount the employee contributes up to a certain defined point. For example, an employer may offer a match up to 5% of your salary. This means that if you contribute at least 5%, they will match it. Now, if you contribute 10%, they're only going to match up to the 5. Again, contributions are made on a pre-tax basis, and for the 403b, employees, if under age 50, are allowed to contribute in 2021 up to $19,500 per year, and in 2022, $20,500 for the year. And those 50 and over for 2021 will put in $26,000, and for 22, $27,000. There are also other catch-up provisions that can total between employer and employee. Check this out. As much as $58,000 in 2021, and like I said before, $61,000 in 2022. The reason I even mentioned the 2021 match limits is because when your taxes come up this April, you're going to have a choice of whether you want to contribute still to your 2021 contributions, or if you want to contribute to 2022. So it's still good to have an idea of what those 2021 limits are. So also for 457B contributions for both 2021 and 22 are the same as the 403B contributions, except that when in the last 3 years of employment, catch-up contributions can be as high as $39,000 as of 2022. Now let's take a look at Roth IRAs. There's another type of retirement account that works opposite of traditional accounts that we just spoke of. And they're called Roth retirement accounts. Roth accounts, whether they are IRA based, 401k, 403b, or 457b based, they all have Roth options to them. And they're all called tax-free retirement accounts. And thus, like I said, work opposite of tax-deferred accounts like traditional IRAs or 401ks, because the growth on the invested assets will be tax-free when they are withdrawn from the account. And they also work tax-free as they're growing in the account. Some of the other stipulations related to Roth accounts are: they must be funded with after-tax dollars, which is the reason they are allowed to grow tax-free and later be withdrawn tax-free. Also, they must be open for at least 5 years before the growth in the account can be withdrawn tax-free. If the growth is withdrawn before that, it actually becomes taxable. Plus, in order to not incur a 10% penalty by the government, a Roth account owner cannot withdraw from the account before age 59 and a half. That is a no-no, unless you want to lose your money. Roth IRAs actually have income limit ranges related to them. So we're good now. Let's just take a minute and let's look at some of the differences between Roth IRAs, Roth 401ks, 403bs, and 457bs. The first difference is Roth IRAs actually have income limit ranges related to who qualifies to contribute to them and how much they can contribute. And the Roth 401ks, 403bs, and 457bs do not have any income limits. So in 2022, the Roth IRA income limit range, because it phases out gradually, starts at $129,000 and ends at $144,000 for a single person, and starts at $204,000 and ends at $214,000 for a married couple. However, when it comes to the contribution limits for both traditional and Roth accounts, they are all the same. So it doesn't matter if it's traditional or Roth, the amount that you can put in them all is the same for every type that I just mentioned. Second thing, Roth IRAs are never subject to required minimum distributions, otherwise known as RMDs. I think maybe some of you have heard that before, that term. And Roth 401ks, 403bs, and 457bs are actually require you to take RMDs. That's why we always advise clients who have the latter of the two to roll them into Roth IRAs before they turn 72, which is now the RMD mandated age by the government. So as you can see, all Roth-based accounts are desirable because you can withdraw contributions penalty-free and tax-free at any time. It's only the interest that can be penalized for early withdrawal. Now, let's talk about life insurance. There are several types of life insurance policies that are applicable to different situations. In fact, to some people, the differences between them are sometimes controversial. Some advisors strictly believe in buying term insurance and invest in the difference of the cost it would have been to purchase the cash value based kind of life insurance, and then putting that difference into a market-based investment like a mutual fund or an ETF or even a portfolio or different stocks or whatever you choose, even a savings account for that matter. They say that by doing this, you can maximize the amount of insurance you can buy today because term is a lot cheaper. You can get a lot more insurance. And you can then also maximize how much your investments can grow on the other side because you're spending less for the insurance. However, it's been my experience that there are valid times to purchase each type of life insurance that exists out there today, especially because of the tax advantages that cash value-based life insurance offers that really no other types of investments do. You just need to know when it's the right time to invest into each type. So, when it comes to the main types of life insurance, I classify them into 3 different types. The first is cash value-based life insurance, which is any type of life insurance that saves cash inside of it that can accrue interest and potentially last for your entire life. The second is term life insurance, which is any type of life insurance that is just purely life insurance with no cash value inside of it and will only be enforced for a defined period of time. And the third is what I call a hybrid life insurance that is actually a stripped out form of cash value life insurance, which provides pretty much just the life insurance for your entire life, but keeps only enough cash in it to keep the policy from lapsing. So it's like having a term life policy when it comes to how much it costs, although it actually costs about 50% more than a term, but is much cheaper than whole life. And it lasts for the rest of your life when term insurance does not. However, I must mention that I am obligated as a fiduciary to mention that even though a contract between an insurer and an insured states it will cover you for the rest of your life, that is, of course, based on the claims paying ability of the issuing insurance company. So you definitely want to do your homework and make sure that you go with a company that has a strong rating with either AM Best or Standard & Poor's, who are 2 of the most reputable rating companies out there today. So when it comes to these types of life insurance, each of them can play an integral part in the success of a retirement plan at different times. For instance, sometimes to protect a dependent surviving spouse from the loss of the lower Social Security income, it makes sense to use the hybrid type of life insurance coverage to purchase just enough life insurance to replace that lower Social Security income with assets that can last for the last 10 or 15 years of their life. Or another example would be when a couple is young and would like to create a flexible plan that can be used for multiple purposes to assist with both college tuitions and a source of tax-free retirement, as well as a tax-free death benefit to their heirs. Then I personally prefer index universal life insurance because it has the ability to receive a potentially higher internal rate of return over a family's lifetime than a whole life policy. And more of the premium goes towards the savings part of the plan as well. Although I also think that 20 or 30 year term life policy placed on the parents simultaneously in order for them to have enough life insurance in those early years to replace both their incomes in case of a sudden early death is a good idea as well. Just a few bullet points when it comes to what makes life insurance, when it comes to making cash value life insurance attractive as an estate planning and savings vehicle. First, it can be purchased as a way to accumulate savings into a non-correlated asset class, meaning that the returns inside of it do not always correlate directly with the equities and bond markets. and that certain life insurance policies provide the opportunity to accrue retirement savings and guarantees that are not contingent on stock market returns. Also, for retirement, estate, and tax planning purposes, here are some key advantages that it provides. There are no income restrictions required to qualify for it. It has tax-deferred cash value accrual. It can provide tax-free withdrawals or loans. Income from it is not included in the Social Security taxation equation. It is protected from pre-bankruptcy asset evaluations, lawsuit losses, and liens from creditors in many states, depending on the state laws. Finally, withdrawals can be made prior to age 59 and a half without being subject to an IRS penalty. And the death benefit is also tax-free for beneficiaries. So you can see that with all these special characteristics, why so many financial planners find life insurance to be a very important part of many of their clients' plans. Now, let's briefly discuss annuities and how they can fit into a comprehensive retirement plan. Again, just like life insurance, there are several different annuities that have been created to fill certain needs. The most commonly used annuities today are fixed annuities, also known as FAs, fixed indexed annuities, also known as FIAs, and variable annuities, also known as VAs. Also, all three of these types of annuities can also be classified in two more ways, which are immediate annuities or deferred annuities, depending on the customer's needs. What's more, there are also many types of riders that can be added to these annuities in order to add certain types of benefits to them. Some of the most common riders are a lifetime income benefit rider, which will provide an income for life, a liquidity rider, which at some point in time will allow you to take your cash without a surrender value, an indexing strategy rider. Some of them provide certain special, potentially higher yielding indexing strategies that they may charge a little for a rider. And that a death benefit rider, sometimes you'll get a higher death benefit if you purchase a rider, and a long-term care rider. But there are many more types of riders that are all just less commonly used today. They're just a few to mention. Again, just like with life insurance, there's also much debate and some controversy as well on when and if all these types of annuities actually have a place in a client's retirement plan or not. All I can say on that is that I have found that each has its niche to fill in certain situations. If you can identify, as long as you can identify when exactly to use it. However, it's also been my experience that some annuities are more commonly used today than others because they fill a need that is common with many of the clients that we sit down today. For instance, it is very common for even people with healthy retirement savings to have only Social Security for a lifetime guaranteed income source. And for it to leave a gap between how much their Social Security is and how much their monthly fixed expenses are. So for example, they may have a Social Security amount of $3,000 a month, but their bills may be $5,000. And so you have a gap in between them. In this case, it's very common to add either a fixed immediate annuity or a fixed index annuity with the lifetime income riders on them. That will fill the income gap between the client's Social Security and their fixed expenses. Plus, Even though the fixed immediate annuity will usually always provide a higher monthly income dollar for dollar to the client, the investment itself is irrevocable. So once it's made, you can never get your money back, even in cases of an emergency. This is why many people just shop for an FIA, remember, fixed index annuity, that will provide them with the highest monthly income and are willing to invest a little more to fill that income gap and still be in the position to get their money back in case of an emergency. Another attractive feature to FIAs is if the insured passes away early, their beneficiaries will receive whatever money they did not use, plus the return that it earned. With a fixed annuity, beneficiaries may or may not receive any death benefit. And in some cases, if they do, they don't usually get any return that it received. That it kind of depends on the setup. On every case, I've never seen one that actually gave you the return as well. Another common use of annuities these days is as a bond alternative, because bond yields have been at such an all-time low for so long now that it has made sense to start implementing certain types of annuities for investment purposes only. It has been mostly fixed index annuities that have filled this niche and that have been performing better overall than bonds in today's market climate. Finally, although there certainly are different types of clients that variable annuities can work for, in my opinion, since they're the only type of annuity where the principal is not protected, these make the most sense for either a young person that has plenty of time to deal with the ups and downs of the market, or for a very wealthy client that is looking for another tax-deferred source once they have maxed out all their other IRA and qualified options, and who may also like the idea at some later date of annuitizing it to stretch out their tax burden over their lifetime, because they would only be paying taxes on the growth part of each payment. Folks, there's a ton more that we could discuss as it relates to annuities, and we will be taking a deeper dive into them next month in our Annuities 101 webinar. But I think that we covered enough today for you to have an idea of why they should be at least considered for many retirement plans to see if they can improve them in one way or another. Now, the last major type of solution that most financial advisors usually consider for their clients' retirement plans is the need for long-term care services at some point over their lifetime. They do this because someone who is 65 today has a 70% chance of needing some type of long-term care services and support in their remaining years. And the median cost for a semi-private nursing home room in the US today is $93,075 per year. And a private room is $105,850 a year. On top of that, the latest retiree health cost estimate from Fidelity Benefits Consulting estimates that a 65-year-old couple retiring this year will need an average of $250,000 in today's dollars to cover medical expenses throughout retirement. So, to say the least, a potential long-term care event in a person's life can absolutely have an adverse effect on the retirement plan and certainly should be given some serious consideration. So when it comes to long-term care insurance, there are basically two main types. Traditional long-term care insurance, this type is always based on a customer paying a periodic premium throughout the year. Then, if they find themselves at some point not being able to perform on their own, 2 of the 6 major activities of daily living, or ADLs, as they're most commonly referred to, which are bathing, eating, dressing, toileting, transferring, and continence. Then, with a letter of confirmation from a doctor, the insurer will pay on a reimbursement basis for whatever care is needed up to the allowable limits of the policy. However, if the customer is never in need of these type of long-term care services, then their policies will end at the time of their death, with the customer and their heirs never receiving anything back for what they paid out during the life of it. Although, if they do find themselves in need of the long-term care services, with this type of long-term care coverage, it will usually cover things like driving, medication management, home health care, respite services, hospice care, adult daycare, and even extended stays in nursing homes and assisted living facilities. Now, the second type of long-term care insurance that is available for folks is called asset-based long-term care insurance. Although this type of long-term care coverage can also be attained through paying a periodic premium throughout the year, it is most commonly purchased with a single lump sum payment that will cover the customer's premium for the rest of their life. It too is triggered by the customer not being able to perform, again on their own, 2 of the 6 major activities of daily living that I mentioned before, and with a letter, and also with a letter of confirmation from their doctor before the insurer will begin to pay, again on a reimbursement basis for whatever care is needed up to the allowable limits of the policy. It's worth mentioning, though, that usually it can be arranged for the insurers to pay the service providers directly for their services as well. Now, this asset-based long-term care coverage is usually a hybrid combination of both long-term care coverage and either life insurance or an annuity, depending on which the customer qualifies for from a health perspective. The long-term care life insurance type usually requires a full medical exam and proof of insurability, when the long-term care annuity type does have to pass through underwriting, but requires much less proof of insurability, and basically just looks to make sure that the customer can presently perform all six major activities of daily living. So what many people like about these types of hybrid-based long-term care coverages is, one, they can provide a bona fide long-term care coverage that can be purchased in one lump sum. And if it is not used, then their beneficiaries can receive their assets back in the form of a tax-free death benefit, when they would have had to pay taxes on the assets otherwise. 2, the long-term care benefits from them, as well as those from traditional long-term care policies, are all paid out tax-free too. On the other hand, had these folks paid for these long-term care services directly from their tax-deferred and taxable accounts, they would have had to pay taxes either at the income or capital gains level for them. 3rd, some insurers that offer these hybrid policies have payout options that will pay out benefits for the customer's entire lifetime, which is a great form of protection for all their other assets in case their longevity works against them from a financial point of view. So, with these 2 types of long-term policies, long-term care policies available today, most financial planners look to implement at least one in order to protect their clients from the devastation of a potential catastrophic long-term care event that could derail their whole retirement plan, which they worked so hard for their entire life. Although there are many more things to know about both long-term care insurance, as well as all the other major strategies and solutions that most financial advisors at least consider when developing an advanced retirement plan. I hope that we have discussed enough about them for you to now have a basic understanding and awareness of them and their purposes. With that said, let's take a look at some before and after scenarios that most financial advisors will explore when creating and developing an advanced retirement plan. When a financial advisor has all the details of a client's current financial situation in hand, it is referred to as our base case. It is then when developing a plan that many times most advisors will introduce various types of financial strategies and solutions in order to see if they can improve the overall performance of the plan. When we do that, we refer to the outcomes related to it as the plan case. Also, in order to do this in a more time efficient and accurate way, most financial advisors today do so with the assistance of various types of financial planning software systems. There are many of them to choose from. I myself, over the years, have worked with at least a dozen of them or more. 2 or 3 for building out full retirement plans, and various other supporting software to develop facts and figures for the overall plan. It's used to create things like, the supporting systems are used to create things like Social Security maximization reports, tax mitigation reports, and investment portfolios that generate certain figures from them to be entered into the retirement planning software for the overall plan. So for this workshop today, I've chosen a new retirement planning software that will allow us to isolate on some of the very specific strategies and solutions that we covered today in our workshop in order to demonstrate to you live or semi-live the before and after effects that each particular isolated strategy or solution will have on the base case, thus creating some base case versus plan case scenarios. I thought that this way of doing it would be the easiest way to demonstrate to all of our attendees today some of the how, what, and whys of building an advanced retirement plan. Although today's webinar is really only focusing deeply on the black and white financial impact of the most common elements of a retirement plan. It does not address the impact of any serious estate or advanced tax planning as it relates to how one positions themselves to take advantage of certain IRS rules and regulations, or any advanced business entity planning that can be very helpful as well. So basically, we're just going to focus on the numbers, not the tax rules and any advanced business entity planning. So that being said, this is by no means these comparisons the only value that a good financial planner might bring to the table. It's just a piece of the puzzle. When a financial advisor has all the details of a client's current financial situation in hand, what are we talking about? Sorry about this. Right, sorry. Like I said, it's referred to the base case. And this is when developing a plan, this is many times when an advisor will introduce other types of strategies. Hold on a second. So, got some notes here, and I'm just making sure that we're on track here. All right. Okay, so let's check out the base case. Before we jump into our software, I want to tell you a little bit about the base case and how it was made. I want to give you a little bit of background on what information about our clients was entered into our software. The basic information that this software requires is the client's name, date of birth, estimated date of death. I usually use 82 for men and 85 for women, which is actually a little higher than the U.S. averages of 76.3 years for men and 81.4 for women, according to the CDC. But in this situation, you want to make sure that you have enough if you live longer than expected. Then we enter qualified assets, taxable assets, income needed, which is another way of saying expenses, pensions, Social Security amounts, debts, and finally, what the assumptions will be related to inflation, investment discount rates, and state and federal income tax effective tax rates. Once all that's entered, then you push the run button, it's called, and it will show you this screen here. You can see 3 categories on the very left that say need, base case, and plan. To the right of them are 4 columns that have headings that say portfolio longevity, which is referring to the number of years until the spouse of the longer life expectancy, which is referring to the spouse with the longer life expectancy and when they die. It says income for, which is referring to how much their average income need will be throughout their life expectancy, which you can see is $85,284 per year. And what the percentages that need to be met during that time period, what the percentages of that will be during that time period, which you can see is 100% for both the base case and the plan case. However, the way this software works is that the base case and the plan case will be the same until either a stress test, which are located in column 4, where there are those 7 little buttons with different little icons on them that are related to the type of stress that is being applied to the base case. Plus, as a side note, these stressors can only be applied one at a time. So unfortunately, this particular software, you can't add multiple stressors at the same time. Finally, the estate value, which is in column 3 and currently showing $531,563, is what we are solving for when we apply the stressors and the various potential solutions, which I will show you and how they are applied in a minute. So let's first see if the base case has enough assets in it to succeed in getting, and we're calling this, this is an actual case that I worked on a couple years ago, that I changed the names of the folks to Bob and Sue. So we're going to see if the base case, which is what it looked like when they first came in to me, actually has enough in it for Bob and Jane to succeed through retirement. Even if they didn't make any changes to it, or even if we don't make any changes to it, which is just another way of checking to see if they have enough money saved in general. And we can clearly see that they do, because the income floor says that it will satisfy 100%. It will be satisfied 100% of the time. The less it will be satisfied, the lower the percentage will be. This basically means that they could make it through retirement without any help, as long as there aren't any major stresses that would cause them to have to spend any at a higher rate than they are, and thus cause their assets to deplete soon. This brings us to the exact reason why we as financial advisors perform these exercises that I am about to show you on our clients and prospective clients' current retirement plans. We can see then if their current plans under various possible stressful circumstances can make it or not. And if not, can implementing some other strategy or solution, one of the ones that we talked about, either help them or either to mitigate the stressors or maybe even improve their estate growth when it's all said and done. Okay, so now let's take a look at the different scenarios. Now, generally, the first thing we look at is whether the investment portfolio risk level matches the current risk tolerance level of not just the client, but also their situation, which in this case seems to be too conservative because the client started with 1 million and multiple guaranteed income sources that exceeded their monthly fixed income needs by over $5,000, yet their estate size reduced from over 1 million to just over 500K by the end of their life expectancy, which you can see there. This can happen inside planning software even without actually spending any additional money over the fixed needs because of the internal inflation rate that is being applied to their income needs every year. This on its own told us that the client needed a portfolio that aims to at least keep up with inflation. However, I usually look to create a portfolio that can either outpace inflation up to that level that the client is comfortable with too. This portfolio was created to have a potential of 5% long-term and has currently exceeded that in the short. So you can see here, the base case when they came in was demonstrating that at the end of their life expectancy, the two of theirs, that the estate value would be about $531,000. But by changing the portfolio, because that portfolio was made up of mainly cash equivalents, and very short-term bonds. When we moved it and created a moderately conservative investment plan, it actually took it up to an estimated value of $1.1 million. So we could certainly see by making just a few adjustments that there was a lot of help that could be had, and that this was a viable alternative to what they had. Okay, so that you know, when I am performing these exercises to a base case, each of them is performed on the original base case / current retirement plan that the client has when we first meet. So every test you will see will always start with the original base case and will show the impact of the particular stressor being used after it is applied. Here's a situation where a market correction is applied to the base case, and it's based on assumptions related to the various types of portfolio allocation and averages related to how they have performed historically in down markets. That's built in to the software. As you can see, this conservative portfolio could be down around 20%, taking it from roughly $531,000 to $434,000 in a down bond and or fixed income market. Next, we applied the market correction stressor to the new portfolio we created, and even though it was down roughly about 40%, the total assets at life expectancy are still over $200,000 more than they would have had in the original base case. Here we check to see if the base case can still be successful if Social Security were to be cut by 22% in 2034, which is what it's estimated to happen. So even though the assets have reduced from 531K to 438,000, the income floor of the plan is still 100%. So even though this will have a negative impact, it will not affect the success of the plan at the end. Next, we check to see how the estate size with the new recommended portfolio in it is affected by the 22% Social Security cut as well. Again, even though the assets have reduced from 1.17 million to 1.03 million, and the income floor of the plan is still 100%, the overall assets are up from $438,000 to $1.03 million. So it is clearly that this new portfolio has the ability to well outperform the original base case. Now, the next thing we'll check to see is if there can be improved estate growth by changing the account harvesting pattern or doing some Roth conversions. In this case, I checked for all of the Roth conversion opportunities and none of them bared fruit. This was probably because of the age of the clients, which was age 70 for him and 68 for her. And the fact that they were closer to the time when they were going to be paying their required minimum distributions, which is currently starts at age 72. The less opportunity, which caused a lot less opportunity to be there for Roth conversion. However, we were able to determine that if the assets are harvested or spent in a very specific order, then the estate would be able to increase in size from $531,000 to $570,000 when it's all said and done, meaning that this strategy would definitely be worth implementing. Now, since Bob and Jane have a very conservative risk tolerance level, we decided to check if a fixed indexed annuity created as a principally protected bond alternative for Bob could be used to improve conservative estate growth over time. As you can see, it is estimated to increase their estate size from $531,000 to $644,000 over their lifetime. It also could help to reduce the downside potential from a down market, which we saw was roughly 40%, to a percentage much more comfortable for them, which would again make this solution a viable consideration for the plan. After seeing this, it only made sense to check to see if the same thing was possible with a portion of Jane's assets. We found that the estimated estate size grew from $644,251 to $767,664 after adding an FIA for Jane's as well, which then also made this a definite consideration for their plan too. Now, next we decided to see what the impact on their estate would be if each of them were to die early. We will start with Bob because he is older and because men have a shorter life expectancy than women do. Okay, so here's what things look like if Bob were to die at age 73 and 10 months. Remember, he was age 70 when we looked at this plan originally. As you can see, Bob dying early would have a serious negative effect on their estate size moving forward, taking it from 531,000 to 231,000, which is less than half of what it would have been. So to counter this, we theoretically added a guaranteed universal life insurance policy to the plan. Let's see how that worked out. Well, from adding a $200,000 guaranteed universal life insurance policy, otherwise known as a GUL. Remember, this is the stripped out permanent cash value policy that only holds enough cash in it to keep the death benefit in force. You can see that it improves their estate value and growth from $234,335 to $516,939 if Bob were to die early, which definitely should be a viable consideration for this new plan. Of course, after seeing this, we then checked for the same situation with Jane. Here's what we discovered. The value of their estate would be if Jane dies early, which is in this case, age 71 and 3 months. Their estate size over their lifetimes would be reduced from $531,563 to $403. So we decided to see if a second UL policy would help to counter this as well. Again, when we added another $200,000 GUL life insurance policy on Jane, it improved the estate, the estimated estate size from $403,000 to $143,000, making this solution also a viable consideration as well. Next, we'll check to see how a major long-term care event for each of them would affect their plan. This is also going to be the final scenario that we look at. As you can see, if Bob were to incur a major long-term care event that cost them around $8,000 a month, which is roughly what it costs annually today for a like we mentioned, for a private room in a nursing home. Over a 4-year period, their estate would reduce drastically, going from $531,000 to $217,000. Now, let's look to see what kind of impact an asset-based long-term care policy could have to counter this. Well, this one was a real doozy, I have to tell you. Huge impact. As you can see, by adding an asset-based joint LTC policy to Bob and Jane's plan, it's a joint policy, but it only pays as each one goes in, or it could pay if they both were in care at the same time. In this case, it's just showing Bob in. It could have a massively positive effect on their estate size. Not only countering the full loss, but actually helping it to almost double within their life expectancy. Taking their estate from roughly $217,000 to $920,000, which is an additional $700,075. This is the type of impact that makes implementing this solution into a client's plan definitely worthwhile. And it's for sure what we strive for when developing an advanced retirement plan for them. So now we'll check for the same thing with Jane. It looks as though a long-term care event with Jane would have a very similar effect on their estate as it did with Bob, taking it from $531,563 to $217,196 over their lifetime. Now let's see how that same asset-based long-term care policy would work. Now, by adding the asset-based long-term care policy on Jane, the estate value will go from what would have been $217,000 to over $370,000, which isn't quite as impactful as it was with Bob, but I think this was because the internal rules inside the program didn't have her long-term care event occurring until she was 91 years old and then lasting for 4 years from there, which is really an additional 9 years of stress on their estate when you consider that their there was 5 extra years of income needs added to it before her long-term care event started. However, it still turned out to add an additional $153,145 to their estate, which definitely still makes it a viable consideration to implement. Well, folks, that was our last scenario. I can't tell you how much fun I had presenting that to you, and I hope that you now have a better idea of all the things that go into developing the advanced retirement plan. So that concludes the learning portion of our webinar today. We sincerely hope that these advanced retirement planning insights that we've discussed with you today are as helpful to you as they are to us when putting them into a plan. Also, before we jump into our 6-question quiz and our Q&A for it, I want to make a special offer to everyone that is attending our webinar today. I usually charge $799 for a full advanced retirement plan review, like we discussed. But for everyone here with us on this webinar, I am offering a complimentary, no obligation advanced retirement plan review if you book it on my calendar before midnight tonight. However, if for some reason you can't book it tonight, I will still offer you a 50% discount if you book it by Friday this week. Also, I want to take a minute to explain a little about what the review entails and what you can get out of it. So, this is what it entails. First, there's 2 ways we can actually meet to do it. The first is online using Zoom, which is almost just like how we're doing this webinar. But instead, we'll both be able to see and hear each other, and it will be completely private. Secondly, could be the old-fashioned way. We can meet in person at our office in Fort Washington, which is just off the turnpike. I'm fully vaccinated and just got over COVID during the holidays, unfortunately, but I like to think of myself as bulletproof now. So if you're up for it, I'm up for it too. Now, in order to schedule it, Rachel will be putting up a link in the comment box right now for you to book a 60-minute meeting on my calendar. If you do so before midnight tonight, the review will be completely free of charge. And if you do it by Friday, it will be 50% off. Second, the review itself, it is a 2-step process. We would meet to gather all the information that I need for the review. So we'll meet one time to gather all the information. Secondly, we'll meet a second time in order to review the results. So what you can get out of this is a clear understanding of whether any of the retirement factors and considerations that we discussed today can be applied to your plan in a way to help improve it. Okay, folks, we're now going to jump into our 6-question quiz and our Q&A session before we wrap things up. All right, let's do it. You ready for this, Rachel? Our first question. What is one type of retirement account that we discussed? Just one type of retirement account that we discussed. Anything?
It looks like Angie got it. She got Roth IRA.
Yay, Angie, good job. Angie, please put in the comment box where you would like your $10 gift card added to or from. Second question. What type of retirement account is tax-free when growing and upon withdrawal? What do you got, Rachel?
You got Roth.
By who?
Patsy.
Patsy?
Yeah.
All right, Patsy, good job. Also, put in where you'd like your gift card from, Patsy. Third, what type of retirement account is tax deferred? Anything?
Let's see. Anthony.
What is it?
Anthony got 401k.
Yes! Great job, Anthony. 401k is correct. There are others, IRA. The others, I don't want to give anything too much away before I get to finish this quiz. Actually, they're the ones that they're finished with the actual account type. So, fourth, what type of insurance solution can pay you an income for life or be used for a principally protected investment for conservative growth?
Oh, wait. I don't have let's see.
I'll repeat that. What type of insurance solution can pay you an income for life and be used for a principally protected investment for conservative growth?
You didn't put the answer in here. Is it 401k?
This is an insurance product.
All right. Cash value life insurance? Whole life?
Keep going. Cash value life insurance doesn't have a guaranteed income for life.
All right.
This type of insurance product does.
Hybrid life, whole life, term,
It's an investment type of an insurance product.
annuity.
Yes. Who got that?
Denise Cheney.
All right, Lise. How do you spell that?
Denise. I said Denise.
Denise?
Yes.
Okay, I can't hear you. Sorry. I'm going deaf in my old age. Okay. Fifth one. What type of insurance solution will pay a tax-free death benefit upon your death?
Will you take term? Because it's life insurance, right?
Yes, life insurance.
Term life,
Just life insurance. They're all forms of it.
all life. Okay.
They all pay a tax-free death benefit. Who got that one?
Well, Frank was the first one to answer.
Okay. So Frank and Denise, if you guys could just put up your where you would like your $10 gift card from into the comment box. Final question. What type of insurance solution is specifically used to pay for care when a person can't fully do things for themselves?
Oh, Angie got long-term care.
Yes, great job, Angie. Angie got two of them, right?
Yep.
All right, we're looking good. So wherever you claim that gift card for or requested it from, Angie, it'll now be a $20 gift card. All right, now we're going to open it up to some questions if there are any.
Okay. Hold on. Give me a second. All right, so how much does a lump sum LTC policy cost? Does it depend what is offered at the LTC or kind of facility?
So how much does an LTC policy cost?
Mm-hmm.
Well, that depends on it depends on a lot of things. It depends on your age. It depends on your health. It can depend on how you want to use it. It can depend on if it's going to be a lump sum or if it's going to be paid periodically, like monthly or quarterly. Some of them can be 10 pays where they're paid for over 10 years. So it depends on your age and your health. Okay. Again, there are ones that are tied to life insurance. There are ones that are just traditional long-term care. So it can really vary a great deal. Who asked that question?
Patsy.
What?
Patsy.
Oh, Patsy. Okay. So, what we could do is if she wanted to know for herself, I would have to kind of run that up. It's really specific to each person. I can't really say. I can tell you this, that if you pay monthly, or annually, it's recommended that advisors keep it between somewhere between 10 and 7%, or no more than 7% of a person's income. So it could be anywhere. I've seen them though in certain situations when they have guaranteed income go as high as 10% of the disposable income. So, can be in that range depending on, how much coverage you have. Okay, anything else?
What is is estate value what you have left after you die to leave to your beneficiary?
Yes.
What do you mean by estate value?
Yes, exactly. And that was the basis of what we were solving for today. So, and that's what we'll kind of look at. At the end of the day, you want to know if you're going to have more or less as a result of whatever variable you're checking on, or whatever stressor you're adding, or a solution you're adding.
All right, that's it. Those are the only two questions.
Okay. All right, folks, that concludes our workshop for today. I just want to thank everyone for attending, for being the type of people that care enough about themselves and their family to spend their precious time learning about this important information. I truly commend you guys for that. I want to remind you that if you have any questions related to this topic we covered today, or our offering of the complimentary no obligation advanced retirement plan review, or if we did not answer your question in the comment box, which it looks like we did, or anything else for that matter, and you would like to discuss it with me further, Rachel will also be putting up a link for a complimentary 15-minute Q&A meeting with me, so that we can schedule a time at your convenience to discuss that. Also, on behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area. Also, you can reach us at either 215-804-9708 by phone, or at info@plcfs.com, or to make it even easier, just go to our website at plcfs.com, and all our information is always there. Also, please mark Tuesday, February, I believe it, next month. What is it? It's February, the last Tuesday of next month. What is it? Yeah, it's February 22nd at 7 p.m. on your calendar for our next webinar. Our topic next month will be Annuities 101. Remember, we do them on the last Tuesday of every month. So have a great rest of your weeks, folks, and we'll see you then. Good night.
Good night, everybody. Thank you.